Very good evening to all of you. It's my pleasure to welcome you once again into one more initiative of Team Gabhawalla and Company. And this initiative came up with the thought process that GST law is becoming very sector specific, and there are lots of challenges which keep on coming up on a day-to-day basis, which are relevant to a specific sector. Some issues are generic, but so many issues now become very specific. And that's where, as partners, we thought that we should now start looking out at a situation wherein we pick up a particular sector and analyze the indirect tax implications relating to that sector so that we can dive deeper into the relevant nuances and the nitty-gritties relating to that sector. And when we thought about this series, we shortlisted a few industries, and the first industry which always came in the discussion was the real estate sector. To put it very simply, as of today, if you look at the mind space and the time space, as a consultant, more than 15% or 20% of the entire time frame is involved in advising the real estate sector. And that's because inherently the real estate sector in terms of structuring is a bit complex. And more importantly, the GST provisions are also very complicated, and there are lots of developments which keep on happening. So we said that let's look at real estate sector as the one of the first initiatives in the sector specific insights which we plan to do. We wanted to keep these sessions as crisp as possible. This will be a monthly feature, and so every month we will visit some sector or the other, and the relevant participants may take a enroll in those programs and attend the webinars. Collectively, we plan to create a sort of a knowledge repository into each of these sectors. So when we thought about real estate as the sector, again, the challenge which we faced was we felt that today the time span, the attention span is limited, and therefore we wanted to have a session of not more than a 45-minute duration. And when we looked at real estate, because of the various transaction structures and the complexities, 45 minutes seemed like an ambitious task. So we said, let's look at one specific issue in the real estate sector, which was relating to the reverse charge mechanism. And of course, even in the reverse charge mechanism, there are fundamental challenges in the real estate sector. So we said that, yes, maybe we can deep dive into the issues pertaining not to the output side. Lot has been talked about the taxation of free area, whether the 5%, whether when is affordable housing provisions getting attracted. But today we are not going to talk about all of that. What we are going to talk about is the specific aspect of real estate, which is relating to the reverse charge mechanism, situations where the real estate developer is required to pay the tax as a payer of expenditure for its expenses as a reverse charge mechanism. So that is what we are going to talk and focus our attention today. And when we actually thought about this as a topic, perhaps we had not anticipated, but coincidence has it that just last week we have an interesting decision from the Nagpur bench of the Mumbai High Court, which has been publicized a lot, which deals with one of the facets of reverse charge mechanism notifications relating to the real estate sector, relating to the development right. So it's more a coincidence, a happy coincidence that today's session we will also be discussing that inter alia as one of the important facets of the real estate sector. Without much ado, let me straight away go into the fundamentals, and we'll have just a couple of minutes explaining the basics of reverse charge. And as we know, the definition of reverse charge is that the liability to pay the tax is shifted to the recipient. So we are defining it as saying means the liability to pay tax by the recipient instead of the supplier. Mark these words, instead of the supplier. Therefore, essentially, this is not a matter of choice. Through a notification, wherever reverse charge mechanism has been prescribed, in those types of situations, the supplier is absolved or freed from the obligations of paying the tax. It will be the recipient who will pay the tax. So while in a normal case, a supplier earns an income, undertakes some activity, let's say providing a service, earns an income, receives some money in his bank account, he would, along with that normal receipt, collect the GST, and after collecting the GST, paid to the government. But as we know, in a reverse charge mechanism, instead of the supplier collecting and paying it to the government, it is the recipient itself who is required to pay the tax to the government. This tax is to be paid on an expense or an outflow of the recipient. Now, this fundamental understanding, though it's very simplistic, And someone might feel that why is this being stressed so much in the advanced session like this? I think even in an advanced session like this, when we go to some controversial issues, understanding this fundamental basic that when we talk about reverse charge mechanism, we have to anchor not on what I am doing or what I am supplying. We have to anchor on what is my receipt of service, what is my expenditure which I'm making, the payments which I'm making. And then anchoring on the payment, whether monetary or non-monetary, I will analyze the applicability of reverse charge mechanism. So the entire coin is flipped, it's reversed, and that's why we say this is known as reverse charge mechanism. Now, some fundamental basics, again, just a couple of minutes dealing with it. Please understand that reverse charge mechanism is not an independent levy, but is merely a mechanism of collection, like we saw in the earlier slide. Instead of the supplier, it is the recipient who is going to pay the tax. But that does not mean that the charge is created by reverse charge. What is important is to examine whether the transaction itself is liable for tax or not. If the transaction itself is not liable for tax because of a specific exclusion, as we move ahead, we'll talk about the controversy of exclusion for municipal functions. And then we will have to examine, when we look at TDR and FSI, with this point will become very relevant, that if something is neither a supply of goods nor a supply of service, the question of a notification prescribing a reverse charge mechanism may not be relevant. And therefore, this first point which we are trying to bring in to say that RCM does not create a tax in itself. It's not an independent levy, but is merely, once a tax is decided by the normal provisions of the law, and it is not excluded, not exempted, in that case, who will pay the tax is decided by the concept of reverse charge mechanism. In fact, even the tax rate, valuation, all of those things ideally have to be looked at from the perspective of the supplier or from the perspective of the transaction itself. And only thereafter we can really go into understanding whether RCM is applicable or not. So that's the first basic starting point. Having said that a transaction is governed by RCM and there's a tax applicable, then the second point becomes important, and that again comes from the definition of reverse charge which we saw in the earlier slide, wherein we tried to highlight that the definition says that the liability is on the recipient instead of the supplier. Therefore, if a situation is such that it is governed by an RCM notification, the supplier is no longer given an option to collect the tax. A very commonplace situation happens in case of transport agencies, in which case many a times the transporter collects the tax and pays it, and later on there is a question which is raised on the recipient because the recipient bears the transport as an expenditure and shows it in his P&L account as a freight expenditure, and then officers ask questions whether RCM has been paid or not. At that point of time, lots of controversies happen. The recipient says that, look, the vendor had collected the tax from me and paid it to the government. And officers at times then want to say that, look, I am not concerned whether the supplier has collected or not. I am looking at your assessment, and in your assessment, I don't see a payment of tax. I am aware that matters like this went to the courts in the service tax regime as well. And the courts have been lenient. And if a recipient is able to demonstrate that the supplier has paid the tax, the courts look at a broad logic and say that on the same transaction, there cannot be two taxes. Having said this, please understand that these are situations which will need to go all the way to courts. And therefore, if you know, as a recipient, you are aware that your transaction is governed under RCM, please do not look at those judgments and try to be, casual and ask the supplier to pay. I would believe that in cases where you are governed by RCM, you yourself should pay the tax, and we should use these judgments only as a saving grace in situations where we have been caught unawares and at a later point of time, the audit or the department teams raise up these types of issues. The next point is a no-brainer. RCM is a tax which you pay on your expenses. And because the credit is available for payment of taxes on your outputs, we are very clearly told that the tax which has to be paid under RCM cannot be paid out of accumulated input tax credit. It has to be paid out of cash ledger only, and the offset also will happen from the cash ledger. Specifically in the context of the real estate sector, we are seeing many organizations had an opening balance of input tax credit, and because of some other provisions, they are unable to utilize that credit because we are told that the 5% tax on the output side has to be paid necessarily in cash, and they are therefore stuck with accumulated input tax credit. Please keep in mind that this input tax credit also cannot be used to pay the RCM tax, and therefore it will just remain a paper asset in the case of real estate sector in many situations. And this is a typical problem which many organizations are facing. So yes, this is one point which we are aware of. Last year there has been some amendment. Of course, there was always a provision which defined how invoicing has to be done. And here unnecessarily we have complicated things by saying or bifurcating RCM cases into two situations. Supplier is registered and unregistered. If he is registered, the supplier is expected to raise an invoice and upload it on my GST returns. And if he is unregistered, then I have to create what is known as a self-invoice. And the next slide will deal with this topic as well as the time of payment of RCM in detail. So I'll just skip it for the time being. Let's move to the last point, which says that, and this again comes as a contradistinction to point number 3. And point number 3, we said that if you already have an accumulated input tax credit, you cannot use that credit to pay RCM tax. But having paid the RCM tax, generally credit is available. Of course, as far as residential real estate is concerned, we are aware that there is no ITC. So for those cases, no ITC. But if you are into some commercial real estate development, then you will be eligible for credit once you pay the RCM. In fact, that's the reason when we look at TDR, FSI, and other provisions, we might need to strategically distinguish between TDR for a residential development versus a TDR for a commercial development. In fact, in our subsequent slides, we'll be also talking about situations where there are mixed usages. And we will try to deal with those situations one by one as we go into the respective provisions. So with that little bit of a background, a couple of points which we left were relating to the invoicing and the time of payment of tax. And this is where I think we will have to go to section 13, which defines the time of supply. And that section is closely integrated with section 31, dealing with the raising of the invoice. And here, unluckily, we have a very tricky type of a situation. Section 13.2 deals with a case where the supplier is registered, but the transaction is under reverse charge. You can have many examples. A transporter might be registered because he's also providing warehouse services, but he is also doing GTA and he has not opted for forward charge. So despite being registered, the transaction is governed by reverse charge mechanism. In these types of situations where the supplier has a GSTN, the law mandates that supplier to raise a proper invoice, like a tax invoice under Rule 46, including all details, including the GST component also. But make no mistake, while the supplier will raise an invoice of 100 plus 5, he will recover only 100 because the 5 rupees of GST has to be paid by you. So he will put a tick in that document saying that tax has to be paid by reverse charge. He will even upload this invoice in his GSTR1 and he will plot a liability when that liability will appear in your GSTR2B as RCM transactions. So in this situation, you don't need to create an invoice as a recipient. You have to follow the invoice of the supplier and you have to respect the tax liability disclosed in the GSTR2B. At the same time, we have section 13, which says that in these types of situations, you will pay the tax at the time of payment or the 61st day immediately following the date of the invoice. Now, therefore, you might find in these types of situations, there will be a gap between the transaction in 2B and the date of payment, and necessarily you will be required to maintain a reconciliation. We are seeing that nowadays there are queries being raised based on this RCM plotting in the GSTR2B. But yes, those queries will have to be answered and explained sufficiently. So this is as far as supplier is registered. He is raising an invoice on you, but the transaction is governed by RCM. There could be situations where the supplier is unregistered, and there could be many such situations. Most common example would be an advocate who is outrightly outside the purview of GST. So in most situations, a law firm will not be registered. And if he is not registered, he will still raise a commercial invoice on you. Because he's not registered, he's not governed by the GST law, so he will not prepare a GST invoice. He'll just raise a commercial invoice. And in these situations, we are told that a specific obligation of raising a self invoice is cast on the recipient. So, as a recipient, you are not only required to pay the tax, you are also required to generate a self invoice. And this self invoice has to be generated within 30 days of the receipt of the supply. The moment the service is received by you, within 30 days, you have to generate the self invoice. And then we are told that you have to pay the tax yourself. And this tax has to be paid either on the date of payment or the date of self invoice, whichever is earlier. So, this is how we deal with non registered suppliers. There's a very specific proviso to section 13.3, which deals with a situation of you making a remittance or receiving a service from a related person or an associated enterprise located outside India. In this case, only limited to case of associated enterprises outside India and import of service situation. There is one more variable in this entire time of supply, which is the date of entry in the books of accounts. In this situation, if you are creating a provision or an entry in the books of accounts, that entry itself would trigger a tax liability. Of course, in real estate, we may not have many examples of cross charges here, but if in general in MNCs, this is creating a lot of problem because at the end of the financial year, provisions have to be created in the books of accounts and payments might happen or finalized amounts might be decided a few months later. Despite all of that, we have a trigger point of tax liability on the date of entry in the books itself. And therefore, associated enterprises creates a little bit of a challenge. Now, when we talk about these situations of invoicing and time of supply, please understand the implications. Invoicing is the time when you commit a document and say that this is my transaction. As compared to that, the time of supply is the time when you end up paying the tax to the government. Interestingly, wherever credits are available, we are told credits will be available basis the invoicing, not basis the payment. Of course, if you are going to make the payment, you can't get a credit without making a payment. So there is always a clause which says invoicing subject to the actual payment being done. So in that sense, invoicing and credit goes by the right column and the payment of tax goes by the left column in this couple of columns which we are seeing in the table. This again becomes slightly important because in the case of real estate, there are a couple of specific notifications. These are all general notifications, but we have a couple of specific notifications which differ certain types of RCM payments only on the date of OC. And as we move ahead, we'll go into those situations of TDR, lease payments, etc., where we are told that the tax can be, though the tax might trigger today, you can not avoid paying the tax today. You can pay the tax only on the date of OC. So that relief or relaxation has been provided specifically for the real estate sector, which we will take up later. These are what you are seeing on this slide is the general provisions of the time of supply and the invoicing obligations. Now, with that general discussions on the RCM in general, we now go to the real estate sector. And again, when we look at real estate sector, I think what we need to now discuss is what are the situations requiring RCM. Again, there are many. So the first two are again general, applicable to many of the sectors, but I have picked up only situations which are more commonplace in case of real estate. So we'll talk about notification 13, which is a catch-all type of a notification. The general RCM cases, we have a table. We'll quickly run through that table. There is another notification under the IGST Act, which deals with the import of services, remittances made abroad. So we'll deal with that. And thereafter, we'll go to the specific real estate notifications. These are all, the third bullet point onwards, are all notifications or entries which deal primarily with the real estate sector. And our focus today is going to be on entries from the third bullet point onwards. And the third bullet point is the popularly known as 80/20 URD RCM mechanism, the specific notification where real estate developers are expected to procure not more than 20% from unregistered dealers. If you procure more than 20% from them, then there is an RCM which triggers, and we'll understand the nuances of that notification. Thereafter, we'll talk about the FSI and TDR and other monetary compensations paid to municipal corporations. We'll deal with lease premiums. Thereafter, we'll deal with other payments made to government authorities. There are different types of payments you make to municipal corporations, state governments, etc. So we'll deal with that. And finally, we'll deal with the non-monetary component, the joint development and the redevelopment agreements. So this, I think, is the flow of discussion which we plan to do today. And as we move into the specifics, some of them may become a little bit heavier. So let's start with the general one, and then we'll go to the specific types of situations. So the general list of RCM, most of us are aware, and we are not going to spend too much time on this uh, uh, table. Seven or eight specific situations which typically a real estate entity is governed with is the first and the most common place is GTA. Of course, we are aware that when you procure raw materials, let's say cement, steel, etc., you might procure the products and you might also pay the transporter. That transport charge is paid by you to the transporter, automatically become a subject matter of RCM. It's not only raw material transportation which is relevant. Can be situations where there will be a movement of goods across sites. There can be situations where post demolition of an existing structure, there will be dumping of that product and there will be transportation of the waste. All those situations where you are appointing a GTA and that GTA issues a consignment note. In that case, you are required to pay RCM. We are aware that the tax rate is 5%. You can see a small asterisk here, and that asterisk is because that in case of GTA, the reverse charge mechanism is optional, and the transporter is given an option of filing a declaration and choosing to collect and pay the tax. So if he has filed such a declaration, in that case, you need not pay RCM. He will collect the tax from you and pay. He again has two options, 5% without input credit and 12% with input credit. But that's anyways the transporter's headache. So we don't go into that detailing too much. For us, it's simply saying that whatever are my freight expenses, whichever be the nature of that freight movement, so long as there's a consignment note issued by the GTA, I will pay RCM at 5% and subject to certain specific exceptions, we might have a change in that situation. Second is legal, and this is one expenditure which many real estate organizations have. They have a lot of expenditure for drafting of contracts. Many a times there will be negotiations for redevelopment agreements. There will be title search being conducted by advocates and law firms. At times there will be disputes between the stakeholders, and you might appoint an arbitral tribunal. So all these types of payments which are made towards procurement of legal services is under RCM, and you are required to pay GST at the rate of 18%. Or most of the other places it's 18%, except the GTA and rent-a-cab, which are at 5%. Otherwise, most of the other situations will fall under the 18% tax bracket. So here you have 18%. The third is situations where you undertake sponsorship of various events. And real estate is a target, especially for many local events like Ganeshotsav, Navratra, etc. Those local events, most of the associations and NGOs approach the real estate bodies for either advertisements or sponsorships. Please understand this difference. In an advertisement, you just put a banner or something, whereas when you talk about sponsorship, each of the event you are said, let's say you are told about as a title sponsor, or you will be sponsored for a particular day, you are more associated with the event. Moment If it's an advertisement, then RCM does not apply. But if it's a sponsorship, RCM comes into place. And there's a small amendment this year. In case of sponsorship, the supplier status, if is other than a body corporate. So, for example, if it's a proprietary concern, or many times it's a small association, a registered association, unregistered association. In all those cases, if you are either a body corporate or a partnership firm, RCM applies. If your entity itself is proprietary, then you don't need to worry. But if you are a partnership firm, including an LLP or a body corporate, and you make a payment of a sponsorship to any person other than a body corporate, RCM will get triggered and you will have to pay the tax. The next couple of entries are also recent. The next entry deals with renting of residential property, in which case we are told if you are a registered person paying to any other person for renting of residential property, in that case, RCM applies. And a common debate or a question which comes up in many situations is that if there's a redevelopment project or a rehabilitation involved, real estate developers end up paying certain monetary compensation to the existing tenants for rent cost which that person has to pay for the period during which the building is getting reconstructed. So every month some 30,000 or 20,000 will be agreed, and that is paid to the existing tenant from the date he vacates the existing premises till the time he gets a new premise. And a very common question comes is whether that payment will get governed by RCM under this entry. And my answer to that is clearly no. Please understand, it's not for what you are paying. It's whether you are receiving the service or not. In this example, the service of renting is received by the tenant. You are only reimbursing some cost. Again, that reimbursement may not be actuals. In some cases, if that tenant has his own building or his own alternate house, he may not pay any rent. He will just get this money and be happy with that money. Therefore, these types of payments made, though the agreement might say that this is payment towards rent, some amount is paid towards brokerage, etc. These are actually not receipt of services by the real estate developer, and therefore those payments do not get covered by RCM. But as compared to that, if let us say a partner or a director of the company is staying in a rented property and that rent is paid by the company as a business expenditure or as a perquisite, then naturally this is a situation where the renting service is received by the company, and therefore RCM will get applicable to those types of situations. As compared to residential property, for commercial property, the basic difference is that commercial property RCM triggers only if the supplier is unregistered. So if you take an office on rent, if the supplier is registered, he will collect the tax and pay it under forward charge. But if the supplier is unregistered, the landlord is not registered, in that case, for office spaces and commercial premises, you have to end up paying RCM yourself. If you are a private limited or a limited company, if a director renders a service to the company and receives certain setting fees, in that case, those setting fees become liable for RCM. Please note, if the director is an employee and he receives salary, salary is outside the purview of GST, and therefore there's no question of RCM at all. We go back to our first point, which we had discussed, that RCM by itself does not create a tax. It merely is a manner of payment of a tax which was already created. The next one again is very commonplace: security services for existing sites, potential sites. There is always a security involved. And if that security is supplying security personnel and that body is other than a body corporate, then you have to end up paying RCM. If it's a company, private, for example, a partnership or a proprietary concern, in that case, RCM triggers and you have to pay the tax yourself. That takes us to the last entry of the general cases of RCM, which deals with rent-a-cab operators when you take cars on hire for a day or two, etc. In those cases also, if the supplier is other than a body corporate, you are required to pay RCM. But here, you are required to pay RCM only if you are a body corporate. If you are a partnership or an individual, then the RCM does not get triggered. So when you look at all these general cases, you will find that in this table, you find different words used in the column of supplier status and a recipient status. So whenever you look at a particular transaction, you have to ask these questions to yourself, whether the supplier status is as mentioned in this table, whether the recipient status is as mentioned in this table, and whether the nature of service is as mentioned in this table. If all these three answers are yes, and you tick all those three boxes, then only the RCM will get triggered. These provisions, except a couple of them which have been recently introduced, have been there since long. So we will not go too much into detailing of them. We straight away go to the next provision, which deals with foreign remittances. And here we are told that the import of service is defined to be a case where the supplier is located outside India, the recipient is located in India, and the place of supply is in India. Typically, you might obtain services, let's say, from a foreign architect, and that architect provides you a designing service relating to a site to be set up in India. Because the site is to be set up in India, the place of supply is in India. You are in India as a recipient of this service. The supplier, being the architect, is located outside India. He will raise an invoice. You will make him a payment. Naturally, you will make a payment in dollars through foreign exchange remittances. And these are the types of transactions which are sought to be covered under import of services. Clearly, you will end up paying a GST on these types of import of services. Now we go to the specifics. And the first specific basket of RCM we discuss is the URD RCM. And we are aware that till 2019, we didn't have this concept. But in 2019, the real estate sector underwent a change in terms of overall tax policy, especially in the context of residential real estate. And we are aware that post 2019, as far as residential real estate is concerned, you are required to pay a concessional output tax of 5%. But that concessional output tax comes with a condition that you are not eligible for any input tax credit. Now, when the legislators framed this provision to say 5% without input tax credit, they were aware that there could be situations that people will now try to procure goods or services without tax, meaning they will set up various unregistered firms and procure goods and services from such unregistered firms, so that the overall tax incidence on the project reduces. And therefore, consciously, the government, when they brought in this new scheme in 2019, they also brought in this notification to say that if anyone governed by this new scheme of 5% without input tax credit procures goods or services in excess of 20% from unregistered dealers, because 20% was the tolerance limit which they thought was fair. So beyond 20%, if there's a procurement of goods or services, those excess goods or services will be liable for RCM. Now, when they say excess will be liable for RCM, it brings up Pandora's box, because as we know, the tax rates can keep on changing. There can be different goods with a different rate, services at different rates. And how are we going to say this excess belongs to which type of a goods or services? So the government smartly has said that we will treat all of these as service, and we will take a single rate of 18% for all this excess procurement. So you don't have to worry whether that excess is relating to X product or Y service or X service, and go to the tax rate. It's a standard 18% tax rate which will be payable for all your excess procurement over 20% being URD. When we are doing this, we are told that for capital goods and cement, there will be no tolerance and the applicable tax rate, because cement, as we know, is 28%. Some capital goods also might be 28%. And therefore, these have been excluded from this entire calculation mechanism. They are specifically under RCM without any tolerance at the base rate. What we are told is we have to do this computation on a project basis. And within a project, we are aware that real estate projects last for more than few years. So for each financial year, you have to calculate it, and the tax has to be discharged by the June of the next financial year. To put it in a very simple language, if let's say in a particular year for a project, you have procured goods and services worth 1 crore rupees. What we are told is that only 20% of it can be from unregistered dealer. 80 lakhs will have to be from registered dealer, 20 lakhs can be from unregistered. So long as your unregistered is less than 20 lakhs, there is no problem. But the moment your unregistered goes to 21 lakhs, then we are told that the excess over 20%, the 1 lakh which is extra, will be liable for RCM under reverse charge mechanism at 18%. So this is how broadly you will look at. Essentially, what you will do is you will divide your entire expenditure into two columns, RD and URD. Total the values of RD, totals the value of URD. And if your URD is more than 20%, on the difference, you will end up paying tax. When we say RD and URD column, the key part, and the next couple of slides we will talk about it, will be on understanding what falls in the RD column and what falls in the URD column. Please note that there will be certain items which will be not falling in either of the columns, like salaries, because it is neither goods or services. Therefore, it does not fit within RD or URD. And therefore, we will have a third column in Excel which says not to be considered. So essentially, each expenditure, the process would be, you'll take up your trial balance, you'll take up your P&L account, identify, have a project level working of the breakup of the expenditures in your trial balance or P&L account. And against each expenditure, identify and plot it against one of these three columns, total it up, and thereafter apply the formula in Excel. So that's how URD RCM will work. Essentially, the steps would be, therefore, identification of these inputs and input services, then column, so that's the rows in your Excel. Thereafter, identify the category, whether is RD or URD. Please note that this applies only for inputs or input services which are used for supplying the construction service. If it's a very common type of a generic overhead, not applicable to a project specific transaction, then it will not apply. Therefore, you might need to cull out those types of things and say that these are not considered type of a transaction. Thereafter, total it up and apply the 80-20 principle and discharge the tax. And this entire process has to be done GSTN wise for a financial year within a particular project. So these are the broad process steps. The first couple of steps are critical, and therefore we'll go and understand some examples on the first couple of steps. The step one is identification of inputs or input services. And that's where the definition of inputs and input services clearly says that it will cover only goods or services, because GST itself deals with only goods or services. From a practical perspective, what it therefore means is you will ignore the following aspects. As we know, services rendered by an employee to an employer are neither supply of goods nor supply of services. Therefore, any expenditure on salaries or wages will be excluded. Now, please note there's a difference between a temporary laborer and a labor contractor. If you have salaries need not be always salaries and wages need not be always be a case of a permanent employment. You can also have a temporary employment for 3 months, 4 months. That also creates a valid employer-employee relationship between the company and that individual. But if you appoint a labor contractor who is going to bring for you, let us say 20 people who are going to work in the plumbing department. Now that labor contractor is not governed by an employer-employee relationship, and therefore those transactions will not be excluded. That is a payment which you are making to a contractor. That will, just like you make a payment to a security agency for supplying security personnel, you can make a payment to a labor contractor for supplying certain type of labor. That will be governed by the 80-20 scheme. That is not excluded. Similarly, petrol, diesel, there are lots of cases where you use DG sets at the site and all. So there is a lot of procurement of diesel and petrol that, as we know, are goods which are not governed by the GST law at all. So that is excluded. Same way, electricity is excluded. Now, when you look at depreciation, bad debts, write-off, of course, these are not transactions. So anyways, that should not come. But because we started by saying practically, you'll start with a trial balance or a P&L account, and these appear as your expenditures. Therefore, these are notional amortizations or write-offs. So you will exclude all of this. So after excluding all of this, we then go into the specific exclusions. As far as goods are concerned, we are told cement and capital goods, we discussed it earlier. They are not to be taken for 80-20 calculation, but straight away, they will be liable for RCM if they are URD. So that we will exclude. As far as services are concerned, there are separate notifications dealing with development rights, TDR, FSI, and lease premium. So those payments will be excluded. Otherwise, all the other things will have to become a part of the calculation or identification of inputs and input services. So this is where you are just identifying the rows. After identifying the rows, for each row item, you will bifurcate that amount into whether I am procuring from registered dealer or unregistered dealer. And when we are doing that, please understand that procurement of registered dealer, one easy way to find out is whether he has charged the tax and whether it is appearing in your GST R2B. That's an easier answer, but that is not the full scope of registered dealer purchases. Your procurement from registered dealer will not only include cases where the supplier is charging you a tax, but also there can be cases where the transaction itself is exempted. For example, if you've taken a loan from a bank, the interest is exempted from the purview of GST. But various other charges levied by bank are taxable. So banks invariably would be registered. So when you are looking at interest and looking at classifying that interest as either RD or URD, you have to check whether the interest paid to the bank, whether that bank has GST number or not. That effort you will have to do. And you will find that most of those banks are registered, and therefore you can take it in the RD column rather than taking it in URD column. But if you have private loans from individuals, you might find that those individuals are not registered. And in that case, you will have to take it into the URD column. So accordingly, individual cases, you will have to see whether it will fit within RD column or the URD column. The other aspect is there can be certain composition dealers who will not show tax on the invoice, but they are registered and paying some concessional tax rate on a lump sum basis. Even these situations are to be treated as registered dealer. And finally, where you have paid general RCM, in the first slide we discussed advocates, GTA, security agencies, where you though the vendor is not registered, you have paid the tax. So you can't again plot it in URD column, because moment you plot it in URD column, you will end up paying a tax. So there cannot be double tax. So cases where the transaction you have already paid tax under RCM, general RCM, will also be taken into the RD column, even if the supplier is unregistered. After you do this plotting, you will then also check whether these costs are inputs or input services used for construction. And typically, you will have all the project related costs, which will become a part of your nexus. Certain marketing costs also become a part of the nexus. Many a times you might be advertising the particular project on the radio or on the television or outdoor hoardings. There will be brokerages paid to various brokers and agents. All of that becomes a part of the nexus with the project. But if there is certain general overheads, like a generic type of an audit fee being paid or a general consultancy given, which is not related to a project, but which is more related to an office or the organizational setup, in those cases, those items will not become a part of the calculation of the URD RCM. Again, when we are looking at a mixed project, so while we started URD RCM, we said that the entire background of URD RCM 80/20 is the fact that there is a concessional tax rate against a condition of non-claim of input tax credit. However, we are aware that commercial projects are liable for full tax and input tax credit is available. So for commercial component, which is taxable at the full rate, you do not have this concept of URD RCM. And therefore, if it's a mixed project, now again, we are aware that when you're looking at mixed projects, there are mixed projects treated as RREP where the commercial component is less than 15%. We are not talking about that. In that case, these entire provisions will apply. But if you have, let's say, 40% commercial and 60% residential, in these types of mixed projects, to the extent of 40% commercial, you are eligible for full credit because you are paying 12% tax on the commercial sales. Therefore, in these types of mixed projects, whenever you do the calculations of the RD, URD, etc., you will do it only proportionately on the basis of the residential component. So if it's 60% residential, you will calculate only 60% of this entire table to calculate the RCM tax. So that is something which we need to be careful about. So these are the provisions on the URD RCM. Again, this can be a very elaborate exercise. My understanding and our practical experience is most of the developers make sure that they do not breach this limit of 20%. So therefore, the provisions are more like complied with, but in specific types of situations, you need to make sure and do a yearly calculation to make sure that you do not breach this limit of 20% in any manner. That takes me to the next entry, which deals with, and from here onwards, you will find that there are sometimes not very clear answers because the law itself is a bit fluid. And that fluidity is because various decisions bring out different facets of those things. So the first facet which we will deal with is the FSI and the TDR payments. There is entry 5B of the general notification 13, but because this was specific to real estate, we didn't take it in the original table, but we are discussing it right now. As per this entry, GST at 18% is payable on the payments made towards FSI or TDR. Make no mistake, the entry just speaks this much. It says 18% tax. Promoter, as defined under the RERA, will be liable to pay this 18% on any payments made towards FSI or TDR payments. But through a couple of other notifications, we are told that in case of residential projects, the tax is deferred till the date of the completion certificate. So, in case of residential projects, this tax, though it might be payable as per the general entry on the day you make the payment, we are told that you can defer this tax till the date of completion certificate. And to some extent, this helps because of the cash flow issues. At the date of completion certificate also, we are told that you need not pay the full 18%. We are given a partial exemption. We are given an exemption to the extent of sold units. So on the date of completion certificate, because you are paying taxes on the units sold prior to OC, we are told on the date of OC, calculate the ratio of sold area and unsold area. So if let's say your sold area is 85% and unsold area is 15%, we are told you pay tax only proportionately to the extent of unsold area. So if let's say you have paid 5 crores as FSI, on that 5 crores, 90 lakhs would be the tax. But 85% of the built up area you have sold. So only 15% of 90 lakhs will be payable, and that will be payable on the date of the OC, because unsold area can only be known on the date of OC. Finally, we are told that this amount shall not exceed the tax payable on the unsold unit if you sold it prior to OC. Because this is again a very commonplace logical thing, that if otherwise what people would do is they would sell all the units prior to OC and pay that tax. So the government says don't go into that hassles. If we will make sure that you will not end up paying a tax which is more than 5% of your unsold inventory. In market, because this is very complicated to calculate, very simply the industry understands this provision as if it's a tax on unsold inventory. But please understand, this is really not a tax on unsold inventory. This is a tax on FSI and TDR payments, which is given an upper limit that it will not exceed the tax of unsold inventory. So this is one entry which becomes very relevant. Having said that there is this entry, we need to bear in mind that there's a notification 14 just after this notification 13, which says that if any payments are made to municipal corporations or local authorities for a function, statutory function prescribed to the municipal corporation under Article 243W, in that case, the transaction will be excluded from the purview of GST. And this is where in the service tax regime, we were told that regulatory functions of municipal corporations are governed by 243W. And there's a strong school of thought to say that this entry, notification 14 entry, covers FSI payments, because end of the day, if you look at what is FSI, FSI is a local authority's regulation of how much construction can be done in a particular area. And therefore, there are regulations in that regard. And these regulations are clearly a part of the town planning mechanism, which is one of the listed functions or activities entrusted to a municipality by Article 243W of the Constitution. Therefore, there is a strong argument to say that while you created this notification will not apply if I'm making a payment to a municipal corporation. A conservative view is that notification will prevail, but a more correct and a legal view might be that you will have to look at this municipal function argument. And if that argument is taken to its logical conclusion, then FSI TDR paid to municipal corporations will not be governed by the RCM. If we take, and I'm aware that there have been litigations and show causes on this point as well. Now, somebody might say that if I treat municipal payments as outside the purview of GST, then what does this RCM entry cover? In my view, then the RCM entry will cover FSI and TDR payments made to third parties other than municipal corporation. We are aware that especially in the context of TDR, I can purchase TDR from an open market, and that type of an open market purchase of TDR from somebody else who has, let's say, constructed a slum for the government or has constructed some public parking lots, they are all compensated by way of TDRs. And that TDR then might find a place at your location. In those types of payments to third parties, they would be governed under this RCM entry. That is one way to look at it. A conservative approach would be to, yes, accumulate all these FSI TDR payments. Also, if it's a payment made to a municipal corporation, add that also. And then finally calculate it on the date of the OC. When I'm talking about this deferment, again, a reminder, this deferment applies only in case of residential real estate projects to the extent of the residential component. In case you are having a commercial component, then to the extent of the commercial component, none of these deferment applies or partial exemption applies. So on the date of payment, to the extent of the commercial component, you have to end up paying the RCM, along with the fact that, yes, after paying the RCM, you will also be entitled for input tax credit of the RCM so paid. So this is entry 5B, which deals with FSI and TDR payments. Next to that immediately is entry 5C, which deals with lease premiums, lump sum lease premiums paid to municipal corporations or government bodies for obtaining a land on a long-term lease. As we are aware, in places like New Bombay, you will be allotted a land parcel by CIDCO against a payment of a long-term lease. This type of a long-term lease also is governed by RCM. Again, the provisions are similar. You will not pay tax immediately in case of residential projects. You will wait till the date of OC. On the date of OC, you will look at your unsold inventory and tax will be payable only to the extent of unsold inventory. Again, in case of mixed projects, if you have also doing a commercial development, to the extent of commercial development, you will have to attribute the value based on the area of commercial development and pay tax upfront along with input tax credit. So in that sense, land lease and FSI TDR payments are similarly placed in terms of the notification, and therefore we can go to the next one, which is the general government related services. And here we have a general law which says that most services rendered by government will be covered. Here there is no deferment. It can be a payment made to a local authority or a state government or a central government. Again, please remember that there are exemptions in terms of small value exemption of 5,000 per annum per entity. Registration fees paid under a statute is exempted, and if the payment is towards a statutory or a municipal function, that also is exempted. So there's very limited item which will fit within this, but yes, this is also an entry which we need to bear in mind. And let me wind up with a final discussion on this case law, which has recently come in, and that's a very interesting situation governing barter. Till now, what we have talked about are all monetary payments, but this slide governs situations of barter. And as we are aware, barters can be in various facets. Two commonplace examples of barters are joint development, where there's a landowner who owns an open plot of land. He enters into an agreement with you, whereby you develop the property. You will enter into an area sharing agreement, and therefore, let's say 40% or 50% of the area will be given back to the landowner against a development right which he has given to you today. You will sell your component, he will sell his component, and various combinations. So that is one mechanism. A second mechanism is redevelopment or rehabilitation projects, wherein there will be a society or some plot where there are tenants, and the society will grant you a development right. And against that development right, you will return back additional area to the existing members, existing plus additional area to the existing members, and whatever is available after allotting back the free area to the existing members, balance area will be sold in the open market. So both these types of agreements, though they are very different, for the purposes of today's discussion of RCM, we can club them together and we can discuss both those situations together. Now, while generally we talked about the entry 5B above a couple of slides earlier, this talks about FSI TDR. A general understanding of the department has always been that this entry of TDR FSI, because it uses the word transfer of development rights, is not only covering TDR, it is also covering these types of joint development or redevelopment agreements where a landowner or a redeveloper grants you a development right. And if one looks at that thought process, which is also to a large extent conservatively accepted by some pockets of the industry, but definitely department is taking that view. What they say is, okay, we will defer this RCM tax to the date of OC. On the date of OC, we will provide you a partial exemption to the extent of unsold inventory, to the extent of sold inventory, pay tax only on the unsold inventory, and pay tax equivalent to 5% of this unsold inventory. And there have been notices which have been issued, and at times orders also confirmed. And it is in this context that one real estate entity went to the Bombay High Court, Nagpur bench, and questioned the interpretation of the department on this point. And the bench was methodical in understanding this provision, and it went into the RCM notification, and it said that, look, this RCM notification uses the words transfer of development rights stroke FSI. And then it went into the urban uniform development control regulations, DC regulations, wherein the FSI term is defined. And also TDR is defined, transferable development rights. TDRs are defined, which we know is a certificate representing the FSI component, development entitlement component, which is transferable across various parties. So, and they then analyzed the entire entry and said that this entry applies only to TDR, which is originating from some municipal authority or some government authority, and then is traded amongst the private parties. it does not apply to a private agreement between a landowner and a developer, wherein a developer is given a license to enter the premises and develop the premises. And therefore, the decision says that the tax cannot be demanded from the developer. Now, while the decision says the tax cannot be demanded from the developer, it opens up a Pandora's box because it does not go into the merits of whether development rights itself is a service or not. And therefore, this in that sense can create some difficulty from a landowner's perspective, because at some point of time, if this decision holds true at a higher forum, the department will then start chasing the landowner and start expecting the landowner to collect the tax and pay. We go back to the first point which we started with to say that an RCM notification does not create a tax. Just like an RCM notification does not create a tax, an RCM notification cannot, when the courts hold that an RCM notification is not valid applicable, it does not mean that the tax is not applicable. It only means that the recipient will not pay the tax, and therefore there can be a little bit of a challenge on this front. While it's a very good decision, and I would also believe it's a correct decision, at some point of time, this can open up more litigation for the real estate sector rather than solving the problems. So I think this tries to cover. I was a little bit fast, but the objective was to cover it within a 45 minutes to a 1 hour time zone. So we have tried to cover it. I think we have a couple of questions. So I'll try to take up those questions. And so I think there's a question from Jitendra to say what is the GST implication on TDR generated on own land, as well as FSI, additional FSI, by paying premium charges to MCGM. I think I've addressed this question. When you are directly paying payments to MCGM, it will get covered under entry 5B. If you are aggressive enough, you can take a position that payments made to the municipal corporation are in the nature of municipal function and therefore not liable. As far as TDR you are generating from your own land and consuming yourself is concerned, there is no monetary payment and therefore no question of any tax. But if after generating TDR, you are selling it to a third party, in that case, that TDR payment made by the third party will be governed under RCM. And I think that is very clear and there's no ambiguity on that part. So I think that's the only question that we have. And I'm sure you found the session useful. There's a question from Mohan Bharti, and I think we'll take that last question. If there's a mixed project involving commercial shops and partial OCs obtained and sold, residential units on above floors are yet to be sold as OCs to be obtained. Should tax be paid on an RCM basis? Now, this is a very interesting concept where, as you are aware, in a city like Mumbai, you have a concept called a partial OC. And the entire GST 2.0 for the real estate, which is based on the new plan since 2019, is all dependent on two facets. One is occupation certificate and second is the RERA registration. So in this case, I think you'll have to go back to your facts, understand whether this project is a single project or are multiple projects. If they are multiple projects, even if this is in the same structure, then necessarily you will have to answer questions for each project separately. If it's a single project within which you have obtained a partial OC, there is a controversy whether we will look at that partial OC vis-a-vis the units for which the OC is obtained or vis-a-vis the entire project. I would believe that you will have to look at it only vis-a-vis the partial OC obtained. So if let's say you have obtained an OC for first to the 10th floor in a 20 floor project, you will on the day you achieve a partial OC, you are going to say that this is like the project getting split into two projects. One project A, which is internal project, which is for the first to 10th floor, and project B for 11th to the 20th floor. And accordingly, you will apply the provisions not only of RCM, ITC reversal, many other provisions you will have to apply by virtually splitting the project into multiple projects based on the partial OCs. So of course, one will have to go through that in a little bit more detail in terms of facts, but this is what broadly I would believe is what one will look at. I think that's all from my side. We'll await feedback from you on this new initiative relating to the sectoral insights. Every month we will have one session on the sectoral insights, which will be on the last Friday of the month, and most likely we will continue to have it between the 5 to 6 type of a time frame. And please watch out for those announcements. And if there are any suggestions, please feel free to send those suggestions to us. Thank you very much for joining this call today.